UBS Securities India and try and figure out what to expect from the MPC this time around. Tanvee, hi, good morning. Good to have you on the show. Help us understand what exactly are you penciling in terms of the monetary policy action as well as commentary, first of all.
Sure. Thank you for taking me in. On the policy tomorrow, we are expecting MPC to keep the policy rates unchanged with the accommodative stance, with the main message that the support to growth continues at this point in time. In fact, we expect the MPC to retain the focus on liquidity recalibration. If you remember in the last policy, they had announced a larger quantum of variable reverse repo rate auction. Even the policy statement should be focusing on resorting maybe a larger quantum again of VRR and likely tapering of GSAP purchases partially or fully in the December quarter. So we are not building in any change in the policy rate. In fact, we are only expecting the first reverse repo rate hike to be happening only in the March quarter of 2022, accompanied by a shift in monetary policy stance to neutral. In terms of policy statement, definitely the next two inflation prints, or I would say the next three inflation prints, are going to surprise positively because of the base effect turning favorable. It is going to provide relief to the MPC members at a time when there's a lot of pressure looking at the other EMs to hike policy rates because the market is getting worried about inflationary pressures, not right now, but beyond as we move into the next year. So I would say they are likely to use this as an opportunity to continue to support a growth, specifically at a time when this is the festive season demand momentum, which is expected to come back and trying to support economic recovery. So we are not expecting any change in the growth forecast as of now in the upcoming policy review tomorrow.
Tanvee, that's an interesting point that you raised, and I precisely wanted to address that. Do you think RBI is going to just yet get into inflation fighting mode? Because growth is something from all parameters, all sectors, and all indicators. It's come back with a vengeance. So growth doesn't really seem to be the concern. The concern now is what's happening in specific with the energy basket and the repercussions and the bearings that it's going to have on inflation.
Sure. So let me take you both through the growth views as well as inflation views. So our lead indicator, which is a UBS India activity tracker, it is basically showing that in the last 8 weeks, the indicator has not really moved. It has kind of moved in a very, very narrow range at around 106. So it is definitely above the pre-pandemic level, but it is not really growing. So on a sequential basis, I would say the growth has actually moderated a bit. Specifically in the month of September, we only have data till 3rd of October, so very difficult to comment what is happening now. Now, if you look at the growth front, we are expecting India to gain momentum in GDP, specifically in the December and the March quarter. We have the festive season, which is starting now. We did recently a survey of 1,500 Indian consumers, which are basically the upper middle class and upper income household. And we realized that people in the top 20% of the basket are quite optimistic on the upcoming festive season, and there is a very likely chances of seeing a pent-up demand, which is going to support India's economic recovery at a time when vaccination pace is catching up. So I would say right now the sequential momentum in growth has slowed down or moderated a bit in the September quarter, likely to pick up in the December and the March quarter, starting with the festive season spend. So at this point in time, it is very critical from a monetary policy point of view to support an economy which is recovering from the pandemic. If I go back to the inflation bit, yes, what we are seeing in inflation is that it is more supply side driven. We have seen inflation being quite elevated, much higher than RBI's comfort zone over the past few months. In fact, our full year inflation forecast is still at 5.5% for the FY22, with core inflation slightly above 6%. what we are seeing in inflation, one, your Brent is heading is already closer to $80 a barrel, which is pretty high, much higher than our comfort zone of $75 a barrel, which we normally pen, where it starts to increase macro risk for India. We are seeing companies starting passing on the rising input costs to the consumers. The retail fuel prices continue to remain elevated. We are seeing ongoing supply chain disruptions globally, including integrated circuit shortage, high shipping rates, and nowadays a new concern of a power shortage in India. So I would say in the next 3 months, we do see supply side concerns being elevated. In fact, our expectation is that inflation is going to go higher from the month of December onwards till March of next year, as a base effect turns unfavorable and all these supply side disruptions begin to impact. So I would say the timing of the policy withdrawal or the timing of policy normalization should be in sync with the time when we are going to see inflationary pressures going up. At this point in time, economic recovery is still fragile. The best is to support economic recovery, do liquidity recalibration, which they're already doing, and start moving on the path of policy normalization, likely in the Fed policy, starting with shifting the stance from accommodative to neutral, and going on with a some hike in the reverse repo rate. So I think the timing of policy normalization is very, very critical, because we are at a we are at a very critical stage where we need to support economic recovery coming from a pandemic, but at the same time we are very, very conscious of the inflation risk on the horizon.
Absolutely, and that's what central banks around the world are doing, and they're providing a roadmap as far as normalization goes. So let's see if we see that in India as well, a timeline. Now, Tanvee, I also wanted to ask you the hints that we're possibly getting from the bond markets. You know, look at the way the yields have been spiking, because the other red flag for growth could also be the currency, right?
Okay. So let's look at what is happening on the bond yields and the currency. So our view is that we are estimating 10-year bond yield at 6.5% by end of March 2022. So we expect it to start rising in sync with our expectation that the policy normalization will gather momentum in the first quarter of next year. That is in the March quarter, as we move towards accommodative to neutral stance, or followed by a reverse repo rate hike. If I look at what is happening on the currency, we need to realize that India imports, we are a net oil importer, and 80% of our oil requirement is nothing but made by imports. And if Brent is heading towards $80 a barrel, then there's a clear view that every $10 increase in oil prices increases India's current account deficit by 0.5% of GDP. Now, right now, UBS base case for global oil prices for FY22 is still at around sub $70 a barrel. That is the average what we are estimating for this year. And my current account deficit is averaging around 1.2% for FY22. So if I assume that oil is headed higher, 1.2% of GDP current account deficit moves to 1.7% of GDP current account deficit. This is still manageable. So unlike 2013 or 2018, when we did see a lot of pressure in the currency market, this time around, we think that India is doing reasonably well on the external vulnerability indicators. FX reserves are at an all-time high, which is giving a lot of comfort in the sense that your reserve ratio, whether it is import coverage ratio or whether it is debt to reserve ratio, are still at a very, very comfortable zone. So we do expect near-term depreciation bias in INR beyond 76. And this timing could also be, in sync with the timing of the US indicating tapering of QE purchases, by likely in November or the December months. So I would say short term, yes, INR could depreciate against the dollar. But we again think it's a very short term move, because the external stability risk in India are very, very manageable. So we are not expecting any massive sell off in INR against the dollar, similar to what you saw in 2013 or 2018. So it should be largely contained. A little bit depreciation, I think, is expected, looking at what happens to the dollar and how the EM currencies behave.
And what we are seeing with crude oil prices at the moment, and of course that's not in our control, but simply because we're one of the largest importers in the world when it comes to crude oil. How big a risk is that to growth? I know you've addressed it with respect to inflation, but just the energy crisis that we're seeing in Europe and China, how big is it a risk for growth in India?
So I would again highlight the sensitivity. So every 10% increase in global crude oil prices adversely affects India's consumption expenditure by around 30 basis points, assuming the entire impact of the increase in Brent is passed on to the consumers. So in that sense, and this impact is not linear. So it's not that the next 10% increase in the global crude oil prices is going to adversely impact India's growth by 30 basis points. So in that sense, the sensitivity is quite high. But again, what you have to realize in India is that it is not only about Brent. Like even excise duty on fuel prices have been increased in 2020, and as we have started seeing in 2021, that petroleum consumption demand has come back. All that is now getting affected in terms of your direct impact on the household consumption expenditure. So I would say the highest impact of the global crude oil prices on India is related to our import bill and current account deficit. But yes, it is going to adversely impact even the household consumption basket, and the direct impact is around 30 basis points.
Oh, absolutely. $10 rise, you see that impact. At the same time, there's going to be currency at play as well. We're in uncharted waters. Let's see how the world gets out of this crisis. US is talking about adding more supplies because the OPEC Plus decided it didn't want to tinker with its production timeline. Tanvee Gupta, thank you so much for joining us here on The Market. Look forward to having you here after the monetary policy